Welcome back to Investing Doc Podcast.
Today we're looking at Wheeler Real Estate.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Wheeler Real Estate. They specialize in a really specific niche. We're talking about grocery-anchored and community retail centers.
Okay, and not just anywhere.
Right. It's heavily concentrated in, secondary and tertiary markets, mostly across the Mid-Atlantic and Southeast U.S.
And that right there tells you a lot about the business model, doesn't it?
Yeah.
This isn't high-end luxury retail.
Not at all.
This is the essential stuff, the needs-based places where you actually have to go. Groceries, the pharmacy, that kind of thing.
Exactly. And that's the key point right up front. It has this sort of built-in resilience to e-commerce. But while the long-term story is getting better, the recent numbers had some noise.
Let's talk about that.
In Q3 2025, total revenue was down about 4% year over year. Came in at $23.8 million versus $24.8 million the year before.
4%. I mean, that's the first thing an investor sees, and it looks like a red flag. Why isn't it?
Well, you have to look past that headline number. The dip is mostly because of portfolio repositioning.
So they're selling things off.
They are. They're actively getting rid of non-core, lower quality assets to just, simplify the whole portfolio. So while total revenue is shrinking a bit, the quality of what's left is actually going up.
Got it. So you have to separate the cleanup effort from the actual performance of the core properties they're keeping.
Yeah.
What metrics show that?
That's where you look at same property net operating income, NOI.
Right.
For a REIT, that's maybe the most important number. It's the real profitability of the property itself. And what we've seen is that the same property NOI has stayed relatively stable. That's a huge sign.
A huge sign of stabilization. So the tenants who matter, the anchors, they're staying and they're paying.
Not just staying. We're actually seeing some really positive operational trends. Leasing activity is still strong. Occupancy is stabilizing. And importantly, they're getting rent roll-ups on renewals.
So when a lease is up, they're often getting a higher rent.
In many cases, yes. It shows that demand for these specific spots is holding up.
Okay, what about the bottom line? A turnaround story like this is all about controlling costs.
And they have a structural advantage there. Most of their leases are what you call triple net.
Meaning the tenants pay for things like taxes and maintenance.
Exactly. So that gives them really robust property-level margins. On top of that, management has been laser-focused on cutting down G&A expenses, the corporate overhead.
And that kind of focus on G&A, that often comes after some activist pressure, right?
It does. It's a sign that the new team is focused on efficiency. And it's working. It's helping to narrow the operating losses and improve the FFO trends compared to, the messy results we saw a few years back.
Let's quickly define FFO for our audience, funds from operations. Why is that the gold standard here?
Because it's a better measure of cash flow for real estate, it adds back non-cash expenses like depreciation. FFO gives you a much cleaner picture of the actual cash the portfolio is generating. The fact that it's improving means the cleanup is working.
And it sounds like the market is finally starting to notice.
Yeah, the Q3 earnings were definitely described as better than feared. I mean, the stock had so much pessimism priced in that when the news just showed stabilization, not a collapse, it popped.
So that sets the stage for what? Upward revisions.
Potentially, yeah. If they can put together another quarter or two of steady NOI and keep paying down debt, analysts will have to raise their estimates.
Okay, let's pivot a bit. You've mentioned this idea of a soft moat. It's not a patent or a brand, but it's some kind of advantage. What is it for Wheeler?
It really comes down to their local scale and specialization. In a lot of these smaller markets, they have deep long-term relationships with the grocery anchors. Plus, you have things like zoning that limits new competition.
So they've sort of built these quasi-local monopolies. If a big grocer wants a spot in that specific county, Wheeler might be the only real game in town.
That's a big part of it. But their smaller size is also, weirdly, an advantage. A giant multi-billion-dollar REIT can't really justify putting a ton of hands-on effort into managing a small community center.
The economics just don't work for them.
Right, they have a corporate playbook.
Yeah.
But Wheeler can spend the time curating the perfect local tenant mix to support the anchor, and they can re-tenant a small space really quickly when someone leaves. That execution and local know-how, that's the soft moat.
But isn't being small also a risk? What stops a bigger competitor from just coming in and copying their playbook?
You can't just copy 2 decades of local relationships overnight. And as for buying them out, well, that's where the valuation comes in. It's so depressed that, as we'll see, there are activists involved who think the private market value of the assets is way higher than the stock price.
That's a perfect transition, because the elephant in the room for any turnaround is the balance sheet. This is a highly levered company.
It is. And de-risking that balance sheet is, it's the central mission right now. It's not about growth. It's about survival and simplification.
So what's the strategy?
It's a three-pronged approach. 1, extend their debt maturities to buy themselves time. 2, refinance high-cost debt when they can. And 3, and this is critical, use those non-core asset sales to just pay down the overall secured debt.
So every time they sell a property, that cash is going straight to debt reduction.
That's the plan. And the good news is the core properties generate enough recurring NOI to cover their interest payments and basic CapEx. The cash flow story is all about de-risking.
You mentioned a complex capital stack. Break that down for us. What does that mean for an investor?
Think of it like a house with a mortgage, but also a bunch of second loans and high-interest credit cards attached to it. They have these layers of preferred equity and legacy common stock structures that have just made the company a mess for years.
It makes it confusing and unattractive to big investors.
Totally. And that's why deleveraging is so powerful here. Since the stock is trading at such a depressed price, every single dollar they use to pay down debt or clean up one of those messy legal issues gives a huge boost to the value of the common stock.
It's the best use of their cash right now.
It is. All those headlines you see about Wheeler optimizes capital with stock exchange, that's them actively trying to simplify the whole thing. It's their biggest lever for creating value.
Which brings us to sentiment. It's been awful, obviously, but it feels like it's turning. The stock recently hit a low around 97 cents.
And that 97-cent level became a really key support zone. It felt like the point of maximum pain. But what really lit a fire under the stock was a huge legal win.
The class action suit.
The appellate court just dismissed a major class action suit, and that legal overhang just vanished overnight. It showed how tightly coiled the stock was, just waiting for any piece of good news.
But there's still a wall of worry, as you call it.
Oh, for sure. Sentiment is improving, but people are still very skeptical. The biggest issue is the ongoing threat of a Nasdaq delisting because of a share shortfall.
That's a serious risk. What else is on that wall?
You've still got governance disputes like the lawsuit from the former CEO who was kicked out, and you have very vocal activist investors like the Stillwell Group constantly pushing for change.
Okay, so a lot of investors would see that activist noise as a negative. Why can it actually be a positive catalyst?
Because the activist is basically doing your homework for you. The fact that a group like Stillwell is so heavily involved means they have done the math and they strongly believe the underlying assets are worth way more than the current stock price.
They see hidden value to unlock.
Exactly. They wouldn't be spending all this time and money otherwise, and we have real-world proof of that asset value.
You're talking about the JNF shopping yard sale?
I am. It sold for $85.6 million. That's a critical external data point. It proves that there's real demand for these kinds of properties in their region. These assets are valuable.
So with the activists involved and this clear discount, what are people speculating could happen next?
The chatter is all about strategic alternatives. It's a credible path. Could be a full portfolio sale to a larger player, could be a take-private deal, or maybe a big recapitalization to finally clean up that messy capital structure once and for all.
So all the cleanup work they're doing now makes them a more attractive buyout target down the road.
Precisely. It makes the company more sellable and at a higher price.
All right, let's flip this around completely. Let's focus only on the bear case. What could derail this whole story?
The two biggest risks are still there, and they're severe. Number one is the elevated leverage. If interest rates were to spike, that debt could crush them. Number two is that Nasdaq listing risk.
If they get delisted.
If they fail to get back into compliance and get forced onto the over-the-counter market, they lose a ton of institutional investors and liquidity. It would be a major blow.
But the whole argument here is that these risks are already priced in, right? If the stock is trading under $2, hasn't the market already assumed the worst?
That is the absolute core of the contrarian argument. The risk of total failure is, for the most part, already reflected in the price. And management isn't just sitting there hoping for the best. They're using their tools, asset sales, stock exchanges, to fight back.
And the other stuff, the governance noise, the execution risk, that's just part of the deal with any microcap turnaround.
It is. You accept that noise for the potential reward. And because expectations are so low, even partial success here, just stabilizing things and managing the debt, can generate a huge outsized return for investors.
So let's bring it all together. What should you, the listener, take away from all this? What's the core investment view?
The core view is that this is a classic contrarian levered play on stability. The underlying assets, these grocery stores, are stable. The whole bet is on management's ability to continue executing this turnaround, cleaning up the balance sheet, getting rid of the legal issues over the next, say, 12 to 24 months.
And if they pull it off?
If they succeed, given where the stock is today, you're looking at potential multi-bagger upside. It's definitely high risk, but it's matched with very high potential reward as they go from being a distressed company to a stable one.
So the story is all about simplification, unlocking hidden value, a really fascinating look into a deeply discounted REIT. If you appreciate this kind of look into individual companies, make sure you subscribe to the show for more.